Hi, everyone. This is Tim Melvin of the Banking on Profits Report and the Deep Value newsletter, coming to you once again from down here in Central Florida, where the cold snap of 50 and 60 degrees has finally gone away, and we're going to edge our way back up to those nice high 70s, low 80s temperatures that I so vastly prefer. And I get back, of course, to sending my daughter in Baltimore copies of our weather forecast, trying to continue to induce her and her fiance to relocate to Florida instead of Chicago next year. Anyway, it's a wild week. Prices were all over the place. We had triple-digit moves in the Dow, swinging first down, then up, and then back down again as everybody reacted to lower oil prices, to statements out of the Fed, and to just all the crazy stuff that Wall Street likes to react and overreact to. We ended up with the S&P down about 60 basis points. The all-world URTH index is down 1.45%, and interestingly, folks hit the bid in the community bank stocks, the QABA, early in the week and never started taking the offers back up. And that index of community banks came in down 4.51%. Now, it's pretty interesting. I want to go back and see if they did any rebalancing here that affected this. Because the index shows so far year to date 2015 down over 6%, while the portfolio stocks in our Banking on Profits report is as a portfolio only down about 80 basis points. And again, there's a lot of bid-ask trading going on there. A lot of stocks last trade is just the bid. They could be up 5% tomorrow if somebody took the offer out. Anyway, I gave a webinar the other night, Thursday night, What Value Investor Looks at 2015. And when I reviewed the webinar afterwards and kind of went through the slides that I used, I realized I'd hit on three common themes for 2015 that actually going to make a pretty cool slogan. Might even have these made into t-shirts. We came up with cash, common sense, and community banks as the way to approach the stock market in 2015. Looking at each of those individually, cash. The reason cash is part of our theme is just based on the simple fact that we cannot find a lot of cheap stocks right now. In the webinar, I talked about the fact that my three major screens were producing record low numbers of stocks. The perfect stock screen came up with just 16 names. That's usually around 30 to 35 stocks. The Schloss screen can be 30 to 40 stocks on average. We came up with, I think it was just 12 names in that screen. So just not a lot of safe and cheap stocks. You just run a low price to book with high F and Z scores. That only came up again with about 19 names. And all three of those lists had substantial overlap on them. So in reality, there's something like 10 names that you could come to the table and say, this is a safe and cheap stock, and we're going to buy this right now, regardless of market opinion. Not a lot to buy. If you came to the market with all new money right now, I don't see how you could possibly get even 20% invested if you were using 1% positions. If you decide to get what I would consider to be aggressive sizing right now and use 2% positions, maybe you could get to 40%, but that's about as far as you could go based on what's actually available as far as safe and cheap stocks at this particular moment in time. Now, you can view cash one of two ways. You can certainly view it as a horrible drag on performance because, after all, what are you earning? 5 basis points possibly right now. Cash is not going to add a lot to your portfolio. However, it does add a cushion against volatility, and you can either view it as an anchor, as a lot of people do, got to be fully invested, keeping up with the Joneses, don't want to miss a thing, or you can view it like as I do. It's a cushion and against market volatility, and it's also a tool. When I have cash, 50% or more in most of the portfolios right now, that is a tool. When the markets finally do stage an inventory creation event and prices tumble down 10, 15%, and all those hundreds of stocks on our almost cheap enough list start to tumble into, okay, now they're cheap enough, I'm going to be in a position to act like an Andy Beal, a Hetty Green, or a Mr. Womack and put money to work and stocks that are safe and cheap. And hold those for several years until they're overvalued and popular again, and sell them for a large gain. Buying stocks in that lower end of the trading range. It's worked very well for me over the years, and I'm willing to be patient and allow for prices to come to me. In my eyes, cash is not an anchor. It's a cushion and a tool. We've got lots of it going into 2015, and after a wacky week like last week, that makes me actually pretty happy. The common sense portion of our theme for 2015 is relatively simple. When you listen to the analysts talk, and they're talking a lot right now, making tons of predictions on what they think the markets may do over the next year, if you listen very closely, the bullish arguments are not based on great earnings growth, certainly not great revenue growth. It's based on the fact that interest rates are going to remain low. And even if the Fed does start to take rates up, they're going to do it very, very slowly, leaving companies in a position to continually financially engineer their income statement with buybacks, layoffs, borrowed money at very low rates. Basically, the bullish argument is zero interest rate policy, ZERP, forever. That's really, I'm not comfortable investing aggressively on what some government official may or may not do. I'd rather consider it based on valuation. And right now, as we discussed, just not a lot of safe and cheap stocks out there. Now, tons of geopolitical risks around. Russia is certainly a wild card as they are really being pushed up against it now by lower oil prices, and they're going to start having some economic problems. I don't think they're going to take the economic problems lying down. You've got the Saudis and Kuwaitis still committed to slowing down U.S. shale, Canadian shale, and Russian oil production and protect their market share. As nice as lower gas prices are, lower oil prices have some geopolitical consequences. They certainly can be disastrous for the high yield bond markets here in the U.S., where an extraordinary amount of shale activity is financed by junk bonds. And oil stays down here. These folks aren't going to be able to make their interest payments. That's going to get interesting real quick, as will the layoffs of higher paying jobs as these companies cut back projects. That's going to hurt the much watched and anticipated jobs report over the next several months if oil prices don't pick back up. So lots of concerns related to the rest of the world. Of course, there's always unrest in the Middle East that we can talk about. Europe is an absolute mess, and we're going to see an unpleasant result in the European markets if they do not take very aggressive stimulus action January 22nd when they meet in Frankfurt. I'm not sure I think that the stimulus actually does anything. Hasn't done much as far as job creation here in the United States, in my opinion. But if the markets are telling the ECB, you better take action because your unemployment rates are too high, your economies are just too weak. Those PMIs that just came in were unpleasant, to say the least. So I think we'll see some aggressive action out of there. But if we don't, hey, that could cause a spillover sell-off in the U.S. markets. If you look at the world with common sense, just listen to what the smart people are saying, the Seth Klarmans, the James Montiers, the Sam Zells, Wilbur Ross. They're all telling you, look, I don't know when it's going to end, but this market's getting really overvalued. The disconnect between stocks at all-time highs and the better but not good economic situation that we see on Main Street is very much in place. Probably will end badly. No way of knowing when, but a lot of smart guys are saying you need to put the brakes on and be careful here. That disconnect very much still exists. You can also look at what I call the big picture indicators. They're not timing devices, but they just give you an idea of how over or undervalued the market is. And if you look at things like the Value Line Median Appreciation Index, total market cap to total GDP here in the United States, of course, the Shiller P/E ratio was tossed around, as is the Tobin Q ratio, showing that stocks are actually trading at pretty elevated valuations. Now's not the time to go chasing your definition of safe, your definition of cheap, and chasing stocks higher. We need to apply common sense and wait for those inventory creation events that inevitably happen. We had a small one last year. Hopefully we get a bigger one this year, and we can buy stocks that are not only cheap, but have the type of margin of safety that we want to have in our portfolio companies. We've got to use common sense, not try to chase the indexes, and put ourselves in a position to profitably react to what the market actually does in 2015, rather than trying to make money based on our prediction on what we think may happen because the Fed's going to be nice and keep interest rates low. So that's the common sense part. The next part is my favorite part. It's the community bank part. Here we can indeed get a little more aggressive with that portion of our portfolio, and mine's pretty heavily tilted towards community banks as we go into the year. It's my favorite sector by far. Got a lot of money dedicated towards these trade of the decade stocks as a percentage of my portfolio. And most of my wife's don't lose my money because I can kill you in your sleep rollover IRA is in fact in community banks at this point in time. So the KPMG banking survey was just out. About one half of community bank executives expect to be involved in M&A activity in 2015, whether as a buyer or a seller. They expect to see some M&A activity involving their bank. It is also cited as one of the main sources of revenue and profit growth for the community bank sector. Only the addition of new products like wealth management, insurance, asset management, that type of thing, cited as a stronger reason for growth. M&A plays a part in everybody's growth plans, pretty much has to. And you've not got the type of economy that's going to create runaway loan growth or the opening of de novo branches one town over. There's already plenty of bank branches to start with. The only way to grow right now is to add products and services, which is kind of a dicey proposition at best, into a very competitive asset management business. So your best path to growth is going to be to buy a smaller competitor. Now, my buy list went out Friday afternoon. I keep thinking today is Saturday. And I had 30 banks on there that traded below book 85% of book value, had loan to non-performing assets, as a percentage of total assets of less than 2% or so, and equity to assets of 10 or higher. Most of these banks have some sort of activist involvement, somebody working to unlock shareholder value. So at 30 of those, you can get that community bank portion of your portfolio pretty well fully invested. Now, if you're like me and you really do not care about stock market liquidity, we put together a list using the screeners at CompleteBankData.com, run by my good friend Nate Tobick. Put together a nice little list of, what did we come up with? 120 banks that are trading below book value and have less than 500 million in assets. The ones they're saying 3 billion is about the number in total assets that you have to remain as a standalone bank, given the current regulatory environment and the cost of compliance with the regulations. So 500 million and less. A lot of these guys are going to get taken out over the next couple of years. A lot of them are going to look aggressively to sell because it's just too hard. It's very competitive. You've got to deal with all these regulations and costs. It's very hard to remain independent at that level without a significant edge. And by significant edge, you're the only bank in your town, and there's no other towns for 50 or 60 miles around, so you can dominate the marketplace. That's going to be an interesting list of banks. I'm going to be really going through that this week, be sharing it with subscribers towards the end of the week once we've had some time to process that data. Most of them are really illiquid, so you kind of can't put them in a tracking portfolio because not everybody's going to be able to buy them. And in some instances, our own buying will positively impact the price and make performance look better than it really is. I like to really err on the side of stricter ethics on that, so I just kind of throw them out there as bonus picks for subscribers. I don't want to paint the tape with my portfolio. I'm pretty happy with that 30 stock portfolio anyway. It's doing pretty well, and I think we're going to have a ton of takeovers in that portfolio this year. Okay. Monday kicks it. We're going to get right into it this week on Tuesday. We're going to have earnings season with Alcoa kicking things off once again, and then we just go nuts with the big financials and the big internet over the next 4 to 6 weeks. All the S&P 500 companies are going to report. It's ridiculous how much money is going to be wagered on traders' guesses about how accurate the guess of the analyst that follows the company is. But it's going to run into billions and billions of dollars. Professional option traders that I know love this time of year, not because they're making earnings season prediction bets. They're just pricing options at silly prices, and traders are paying them because they want to make these earnings plays. So some of the option traders I know that are wise to the earnings game, there's like a Hoover just sweeping up money during earnings season. It's a ridiculous way to run a portfolio, a company, an economy with this silly 3 month focus. But there it is. That's how we run Wall Street. A lot of businesses are managing their bottom line using buybacks and layoffs and other financial tools to make or exceed that analyst estimate each and every quarter. And of course, traders are going to play just ridiculously stupid games over the next 3 months. We're going to take our normal contrarian approach to earnings season. We're going to sit back. We'll take in the information, the snapshots of our holdings, and see how these companies are doing and how things are developing. Probably won't influence us to do very much with our current holdings at all. But we do sit back and we take that contrarian approach. We've got that list of stocks that they're safe, they're good companies, but they're just not cheap enough. Now, this has worked for us very well. They miss earnings, the stock price comes tumbling down into our range. Last quarter, we picked up Lane Christensen on an earnings miss, and that stock is up just about 60% for us already. Quarter before that, we got West Marine. They missed earnings as consumers are still not back into the full swing of the boating and addictive lifestyle things yet. As the economy is still moving relatively slow. So they missed the always highly accurate Wall Street estimates. That stock tumbled right down into our buying range as a percentage of book value. We snapped up the stock and we're up 47% on West Marine in just about 6 months. So we'll be looking for those opportunities. Sometimes we get them, sometimes we don't. Got a feeling we'll get a couple this time around because I don't think that corporate America's performance is quite as stellar as some of the like the GDP print that came out of the government announcement. So I think analysts might be expecting a little bit too much. Maybe we'll get some opportunities, and some of these wonderful companies that are almost cheap enough will become an inventory creation event, tumble down, and be cheap enough for us to buy. If not, we'll continue to use common sense, sit on our cash, and concentrate on community banks for 2015. Now, we made a special offer the other night. I'm going to go ahead and put the link to that offer in the description of this video so you can take advantage of a special offer to get Banking on Profits and Deep Value at a combined price that's about 37.5% off what it would normally be. And you can use our themes of cash, common sense, and community banks to power your returns in 2015. All right, now we've got some big football today. We've got Dallas and Green Bay. I'm going to go watch that one right now. And the Colts-Denver game looks pretty good later, too. Unfortunately, my Ravens lost to the Patriots, but they had a decent season, and you really can't complain about losing to that team in that kind of football game. So anyway, we're going to enjoy the weather and some football down here in Central Florida. And you guys have a fantastic week. We'll talk to you next weekend.